All right, well, yeah, thanks for the introduction, Nicholas. As Nicholas said, my name is Randy Giveans, head of Maritime Shipping Equity Research at Jefferies. So on today's star-studded panel, we have 4 crude tanker owners and 1 industry expert here, ready, willing, and able to talk about one of the most necessary and exciting industries in the world, crude oil shipping. So on the panel today, we have Lois Zabrocky, CEO of International Seaways. I think we will have Bob Burke, CEO of Ridgebury Tankers, Harris Kosmatos, Head of Strategy and Business Development at Tsakos Energy Navigation, and Evan Sproviero, Head of Projects at GMS Incorporated. So we'll start the panel with a little bit of background information, then we'll touch on some of the industry drivers, each company's strategy, and then chat about something you may have heard of by now, IMO 2020. So with that, before we discuss the outlook for crude tankers, I think it'd be beneficial to talk about where we've been over the last 2 years. So in 4Q16, large crude tanker rates averaged $60,000 a day. In 2Q18, fell to $8,000 a day. So, Lois, if you could start us off here, what were some of the specific reasons that caused this sharp drop in rates over those 18 months?
I would say it's a combination of, when oil prices, and consequently bunker prices, but largely oil prices fell dramatically in 2013-14, you really saw demand spike, and we had a nice cycle. And during that time, everybody ordered, right? So, then we had to wear off that order book that then delivered, but it was also combined with, we've also had what I call the, hangover of bringing down those inventories. And, really, this very low market has been a part of burning off those inventories that were in storage.
Sure. Now, in recent weeks, rates have basically doubled. VLCCs, 35, 40,000 a day. Suezmaxes above 20,000 a day. So, Bob, what are some of those demand drivers over the last few weeks, and is this rally sustainable?
I think, like Lois said, a lot of the inventory has been drawn off. It seems to be a lot of pull forward. People worried about more expensive oil, China embargoes, China tariffs, and Iranian embargoes that have pulled it forward a little bit. Is this sustainable? I don't trade ships every day, but the guys that do tell me it seems to have legs. They've been telling me that it's coming for the past 3 or 4 weeks, and this time they were right.
Okay. So you kind of touched on it there. Several policy changes made in the last few months that will definitely impact crude tanker shipping. So starting with OPEC and its partners, Saudi Arabia plans to increase production. They were at 10.7 million barrels a day in October, planning to get to maybe 11 plus by December. So Harris, where do you expect these incremental Saudi barrels to go? And do you think their production will remain at 11 plus million barrels a day in 2019?
Does this work?
Sounds good.
Yeah. We do expect Saudi to cover the lost barrels that Iran will that will come out from the potential Iranian sanctions. Yes, I think the Saudis do have the capacity to go, to over 11, possibly 12 million barrels per day. Most of that will go eastwards, the Asian markets. We have seen some withdrawal, and potentially India with some withdrawals from these markets in view of the upcoming sanctions. So they will find a home into these places. In terms of ton-mile demands, it will be kind of neutral because it's more or less the same distance. But obviously, this incremental demand from the Far Eastern importers, China included, will be filled by U.S. oil exports. So I would expect both the Saudi Arabia and the U.S. oil imports to maintain and increase the supply of oil in view of the Iranian sanctions coming into place in November.
Okay. Lois, if you can add a little more color on specifically the Iranian sanctions by the U.S. and how that has impacted, and maybe some pulling forward of demand, as Bob mentioned, or how will it impact the markets in the coming quarters?
It's interesting, from what we read, the fields are still producing, but exports in Iran have gone down. So you maybe gone down from 1.7 million barrels a day to approaching 1 million barrels a day. So you're seeing an impact ahead of the actual sanctions in November themselves. I think it's interesting as far as the Iranian tanker fleet. they have a very healthy number, more than 36 VLCCs. So now you're starting to see where some of the transponders are being turned off. I think that's simply because you're starting to see them storing on some of their Vs. Not that it's not a contango market, but before they shut their fields in, I think they'll store barrels on some of those VLCCs. That's good for us. That takes tankers out of the market. So we like to see that.
Sure. Bob, looking at U.S.-China relations, China has not imported apparently a barrel of oil in the last 6 weeks or so. So how has that kind of impacted the tanker markets, and where do you see that going forward?
Well, it's hard to sort that out because the market's been going up even though China hasn't been importing any oil. So it's, the challenge of the market, of course, is there were so many moving parts, whether it's the Iranian ships all of a sudden in storage, the effect of 30-odd ships being scrapped, or China stopping their intake. It's hard to sort through. I mean, in isolation, it should have been bad for the market, but I guess the other positive factors have outweighed that.
That's fair. Harris, of those demand drivers for 2019, what is the most at risk for growth? Is it U.S. exports? Is it inventories getting further destocked? OPEC not being able to produce as much as they think?
No, I think everything seems to be falling in place in terms of demand. The demand is there. The demand is healthy. The IEA is projecting 1.4, 1.5 million barrels per day for the next year or two. We will be reaching or going above the 100 million barrels of oil, historical kind of level by next year. So the demand is there. The demand was always there. It wasn't an issue when the tanker markets suffered. It wasn't an issue of demand. It was an issue of supply. So we have healthy demand. I don't think the Chinese will eventually put any material, any tariffs on U.S. imports. They need that oil, so there is no point just to play tough to create problems with their economy and their consumption. We could be seeing some fluctuations in their demand, as we have seen recently, but eventually, I think for the long run, they will be there importing U.S. crude. India is not far behind. India has almost tripled their imports from the U.S. in the recent past, from 100,000 barrels a day over to 300,000 barrels a day recently, and we see this trend developing. The U.S. exports are here to stay. They are on an increase. The average for this year is 1.8 million barrels compared to the 500,000 barrels when the sanctions were lifted. So you can see how the trajectory is developing. And there are many commentators that are thinking or talking about 5 million barrels once the whole infrastructure of the export terminals falls into place. So things seems to be falling into place, and we are at an inflection point where the markets, because of the equilibrium in supply and demand, that the markets will take off. Yeah, and we're seeing glimpses of that.
It's rarely a matter of demand. I mean, demand's pretty steady, 1.3, 1.5, 1.6. I mean, it was only in 08 where the demand really surprised everyone to the downside. And it's really a matter of unexpected supply. We all know how many ships are out there and how many are coming. I mean, the scrapping surprise was a bit of a surprise this year. I think it's more a matter of unexpected contango, backwardation, stocking, destocking, political actions, change in trade routes like the U.S. suddenly not importing from West Africa that changes things dramatically. So we can all plot out what the demand is reasonably well and what the supply is going to be reasonably well. It's the unexpected other geopolitical.
And the supply, as Bob says, it's more or less, there are so many vessels around, and we have seen limited new building activity. And once you place an order, some people freak out when somebody places an order of VLCC or Suezmax. In the end of the day, it takes 2 years to deliver. And within these 2 years, we're going to have the departure of the older tonnage that nobody really focuses on. That today, 20% of the fleet, double of what the order book is today. The global order book is at probably under 10%, both crude and products. Vessels over 15 years are double that. Eventually, by the time the order book delivers over the next 2 to 3 years, these vessels will depart the competitive fleet. So effectively, it will create a void. We could be seeing negative growth in the VLs, even Suezmaxes, and imagine what that will do to rates in a high oil demand environment. We are about, as I'm saying, we're on the runway about to take off. Okay. Very positive.
Yeah, before switching gears to supply, just looking at your respective fleets, in recent years, tanker owners have kind of either focused on the larger tonnage, smaller tonnage, or just a certain sector. But all three of you have large tonnage, small tonnage, refined product carriers. So what are some of the pros and cons to that fleet diversification and even commodity diversification? So any of you want to talk about the benefits there of having crude tankers, product tankers, large tankers, small tankers?
I'll start since we have everything of the above. We have every vessel in any category available. Plus, we have expanded into the specialized sectors like the LNG and shuttle tankers. The benefits, obviously, you get both economies of scale in terms of operating large sister vessels. So you get reductions in when it comes to spares, lubricants, and what have you. And that translates to lower operating expenses and by default and by extension a lower break-even, which allows you to operate profitably or if not profitably, not losing any money in a downturn. On the other hand, we are getting the benefit of different market dynamics. As in our case, when the crude market was suffering, we were compensated by the very healthy revenues that our shuttle tankers, for example, were making. So in the end, it was kind of it was a balancing. It balanced the income of the company. So that's the benefit that you get, kind of different dynamics. On the downside of that, you don't get 100% of the upside in a spike, in a short-term spike, because of this diversity. But in the end of the day, we as a company, the philosophy of the company and the way the company has grown, is not to play the short-term volatility. We're not a financial engineering company. We're a company catered to the needs of our big oil majors, and hence the diversity. It's not, for example, that we wanted to build 9 Aframaxes for Statoil. It was Statoil that came to us and wanted 9 Aframaxes. If the request was for VLs, we would have built VLs or Suezmaxes or whatever vessel they wanted. So in a way, the company has this diversified element because it was, in a way, as a requirement or as a result of our clients' requirements.
It's interesting. I think what Harry's talking about is, really, like when you look at a fleet, like for international Seaways, we actually have joint ventures in LNG as well as an FSO. And the way that we think about it is fixed income versus the fleet that is on the spot market. So when you're talking about diversification, you're looking at, is it products or is it crude? But what you're really talking about, and I think it's important in the way we're running, our companies respectively, is that, you have a fixed element and then you have a spot element. Mm-hmm. But as far as having product carriers and crude under the same house, I think one of the strengths is everybody said the product carrier market was going to come 2 years ago, 18 months ago, and I think that the markets between products and crude are very linked. It comes down to demand, it comes down to refinery margins, and it's rare you'll see them very off kilter for more than 6 to 12 months. So they're quite linked, and you're moving you're moving oil, either refined or raw. So I think it's not really, in my mind, completely separate, but you have exposure across the space, and you're not just limited to one of the sectors.
For me, diversification is tankers or Apple stock. Having different type of tankers isn't really that much of a diversification program. But we're not a public company, and what we have is discrete investments at certain points in time in certain sectors. And we try to look at certain sectors when they think a certain age profile in that sector is undervalued, and we can see some sort of event in the near midterm future that might transform that dynamic and give us outsized returns on those discrete assets. So it happens that we are diversified. We have Vs. We used to have a couple of Suezes. A couple of Afras. So we have Vs, Suezes, and MRs, and each were purchased for a different investment thesis at a different point in time. And we have several different investors, some of whom cross over to different asset classes, but that's just by chance. So we don't have a diversification strategy.
All right. Lois, International Seaways in the process of a fleet renewal program, selling your older vessels, purchasing newer ones, as seen with the recent acquisition of the 6 VLCCs. So why do you feel this is important, and is your growth strategy going forward additional secondhand acquisitions or thoughts on new buildings?
Yeah, everything that we've done has been secondhand. It's been very important for us to not have unfunded CapEx on the horizon 2 years out. We also thought that it was really important to invest during the downturn of the cycle, and we've done that, very significantly, $600 million over the last 18 months. So for us, we're essentially at a leverage where we feel is appropriate for where we are in the cycle. And, as the market moves into, more positive place, we, want to wait right now and see that manifest and really just run a good shipping company in the meantime.
Bob, Ridgebury, relatively old fleet with only one vessel built after 2009. 7 of your VLCCs are between 16 and 18 years old. So what are your plans for these vessels? You plan on operating them for a few more years? And then how competitive are the rates those vessels are earning versus a 5-year-old VLCC that we see at $35,000 a day?
I mean, we run our, like I said, we look for discrete investments at discrete points in time. I mean, I always buy 3-year-old cars because they get them for half price. And they run just as well. It works, and it seems to save me money, and I enjoy the ride just as much. On the tanker side, there is pushback against 15-year-olds and older, at least on the larger ships, and there's a discount. And that discount's going to vary with what the rate environment is. There's a discount because they consume more fuel, but they tend to trade on the shorter routes. I mean, the more fuel-efficient ships tend to go on the longer routes for obvious reasons. So overall, the older ships, when the market's bad, may trade at a discount on a TCE basis at the end of the day, 20–25%. They have more waiting time, and factoring all that in, it can be as much as 25%. They're later to fix than the newer ships. When the market's hot, that discount gets squeezed to 10–15%, depending upon how hot the market is. I mean, right now it's hard to sort out. The VL market's moving up so quickly, it's hard to sort out the noise. It's just almost impossible. As I say, it's the taxi cab theory. When it's rainy out, you'll take any taxi cab. When it's sunny out, you're not going to take the older one. You just won't, because the new one's coming down the pike for the same price. So there's a discount, but our capital cost is very low. We paid, fractions over scrap for all 8 of our Vs. We have 7 now. We scrapped one. And so the capital drag, there's no debt service on any of them, is very low. So we have a lot of operating leverage and no financial leverage, and it seems to suit ourselves and our investors very well. There's low chance of losing any capital in this environment.
Okay. For those of you wondering, Evan is up here for more than just his good looks. He is our resident scrapping expert. So Evan, VLC scrapping is likely to reach the highest level in 30 years. Can you touch on the drivers there? Also, can you give a brief description of what GMS does on the cash buying business?
Sure. GMS is the world's largest cash buyer ships for recycling. So we actually acquire vessels from tanker owners, take possession of the ship, and then recycle it in different yards throughout the world. It's mostly concentrated in the Indian subcontinent, but we do everywhere from the United States straight up through East Asia. When it comes to the drivers right now, I think that the largest thing is pretty much the decreased rates with the oversupply of tonnage that everyone has talked about. As well as the IMO regulations. We don't think that this has really started to have a huge effect, but it's in the back of people's minds. So it's certainly, when people are considering having to deal with the low sulfur fuel oil or potentially scrubbers, and they're looking at those types of investments on assets that are 18, 19, 20 years old, it becomes pretty evident to them that it's time to recycle the ships. So we think that that's probably the largest driver right now. Also, as we have more of these regulations coming in, the older ships with the higher fuel oil consumptions, it doesn't make sense to put these scrubbers on, so they will most likely, in larger numbers, start to come more for recycling.
Okay. Evan, I'm going to add one comment, because we scrapped this ship this past year, and we had 8 older ships. What you find out when you have a large ship is a large component of the value is in scrap, and when the freight market is very low, on the V side, you have two very volatile markets. You have the steel market and you have the TCE market. And you can do some quick math and say, this ship has 300 days, 400 days of its life left. The scrap market could drop $100 in that time period, and that's worth $4 million. So do the math. How many dollars per day TCE do I have to bet the market's going to pick up just to break even? And it's the price of scrap. It's not just the price of scrap; it's the volatility of scrap. If we knew scrap was going to be $400 forever or $450, I wouldn't scrap to the last day. But it's the volatility of the scrap combined with the volatility of the charter market that drives people to scrap early.
Absolutely, and today this is something that we look at every day because it's a decision that most owners that we buy from have to make. And it's been at least a year since the economics have made sense, even to operate a ship with, one more year left on the certificates and gambling with a high scrap price that's $420, $430, $440, whatever it might be today. Everyone knows it's exaggerated, it's too high, eventually it will come down. So that's something that
it's not too high.
No, is that your view, Evan? Yeah.
But I mean, historically, it's much higher than the averages. So, as that comes down, you definitely have to weigh that against the charter market.
All right. Evan, let's assume tanker scrapping reaches 20 million deadweight tons this year. What is your forecast for 2019, and how will the Chinese regulations for, not allowing foreign ships to come and be scrapped, how will that impact the scrapping business?
Well, this year we're already at about 19.8 million tons on the tanker side alone. So I think that we're most likely going to surpass that 20 million mark. When it comes to VLCCs, just to give you an idea on the crude side, there's been about 34 Vs recycled so far this year. That works out to be between 10 million tons. So by example, the last time that we've seen these types of numbers being recycled was between 99 and 2003. The previous peak before that was back in the mid-'80s when we actually saw about 64 or 65 VLCCs recycled per year. So that alone equated about 19 or 20 million deadweight, which is about the total number of tankers today, or twice the number of VLCCs being recycled today. So, this is something that, going forward, we see that there's about 65 VLCCs right now that are overaged, built in 2000 or before, that are going to be in the market next year and very well could become potential demo candidates.
All right, Lois, International Seaways has a few VLCCs built 2001, 2003. Knowing that Bob has an affinity for these kind of good value ships, are you interested in selling those? Bob, are you interested in buying these, or do we need Evan?
Are you a broker, or what's going on?
Are you getting 1.25%?
Yeah, or do we need Evan to look for scrapping?
Yeah, it's interesting because while we have invested in, very new vessels, we also have very well maintained, ships. We had 5, now we have 3 VLCCs that are over 15 years old. And, we look at that, every ship on a discounted cash flow basis, and it has to earn its keep, right? So, we look at what can we sell it to Evan at, what can we earn in the marketplace, and, there are factors. I mean, I definitely believe that the older Vs can earn a living, particularly if the oil curve goes into contango. But until that time, I think there's actually 4 factors. Some of the, the 15+ Vs are less economical from an engine perspective, so they're burning 10 to 15 tons per day, easily more than, your new eco vessels. You have to put them into dry dock every 2.5 years, so you're looking at $2.5 million every 2.5 years. You probably have not yet put in a ballast water treatment system because that whole implementation of regulation got pushed out, and then you're going to look at a scrubber. So, there's a lot of CapEx that has to go into those decisions. So, we've struck a balance with selling a couple of older ships, and the others we look at could potentially earn quite well when the market comes into itself.
Okay. Harris, you brought up. Go ahead, Bob.
No, you asked if I wanted to buy them. The older ships we bought had just passed their 3rd special when we bought them, and they were great pedigree. They were frontline. They were DHT and Euronav, so we like the vessels themselves. And none of them need ballast water treatment system, so we're clear there. And scrubbers don't make sense for them. They only have a year or so left. And we got them to the last special, because they were well maintained before we got them, for $1.5 million. But Lois is right. I mean, your options run out as it gets older. But we wouldn't buy ships that are just a year or 2 left.
Okay. Harris, looking at supply, there's been 56 VLCCs ordered 2017, or the 38 been ordered this year. current order book's about 107 new building VLCCs at 16 different shipyards. So how many of these shipyards are still taking orders? And if you were to order a new building VLCC or Suezmax, when could you get it?
Well, I think the Far Eastern yards have maxed out. Even if you place an order today, you're looking, 2 years down the line. So I don't think there is other than the price element. There is no other incentive of ordering today in order to get the benefit of the upmarket. So if somebody wants to expand into the VLs, for example, it's better to look at a resale rather than place a new order.
Okay. Now, everyone's talking about IMO 2020, so I don't want to have you all feel left out. Bob, what are your thoughts on this? Generally speaking, do you love it? Do you hate it? Is it overblown?
Yes. Yes.
Is it a big deal?
Well, we love it and we hate it. It is a big deal. I mean, the scrubber issue, I'm sure we talked about it. My quick view on scrubbers, a lot of VL people will have them, and the VL market may unfortunately price to a VL scrubber market, which means the traders everyone just had to spend a lot of money to keep up. On the Suezes, less people are ordering them. It could be an advantage in some cases. Afras, it's sort of a push. So if you buy them, you'll probably get a good spread, but they don't consume as much as the Suez. On the MRs, I find it hard to make sense. I think a lot more distillate will move. As we've all heard a million times, we burn about 4 million tons a day in bunkers, which is 4% of the consumption of the oil in the world, and we need about 3 million tons of distillate, which means a lot more crude has to be pushed through the system, a lot more distillate has to move. It should be good for MRs. It shouldn't be bad for Vs. There'll be a lot of disruption, and anything that's disruptive is great for shipping. I mean, the transportation system is so efficient these days that we know how many cargoes move out of the Gulf every day, every minute, every week. And we know when it changes a little bit. So if you look at a total disruption in the transportation system, disruption causes inefficiency. Inefficiency is good for shipping.
Okay. Lois, you've
60
ordered
seconds or less.
Great. Lois, you've ordered seven scrubbers for your Vs.
Right.
Some options for a few more. Have you thought about scrubbers for some of the smaller tanker kind of asset classes? And then if you can touch a little more on kind of demand drivers for IMO 2020. Is it new routes? I think the product tanker trade, it's pretty easy to see the demand impact there, but what about on the crude side?
So, just touching on the scrubbers, for us, because we do have, everything from Vs down to MRs, obviously going for our largest consumers, being in Tankers International is really the premier pool, and looking at, if you assume 50, 60 tons a day on a V, and let's just say the ARB is $300 per ton, it's been $250 on average for the last 12 years, you're looking at $18,000 a day on a VLCC. It's very compelling, right? So if everybody puts scrubbers on, then it's just status quo. So it's interesting. We've taken a balanced approach on the smaller vessels. It becomes like if you take an MR for us, you're moving into West Africa, Argentina, Peru. They may or may not have both heavy sulfur and light sulfur available. In the bigger ships, you're calling a lot fewer ports. You know that you're going to be able to get your heavy sulfur fuel. So we've kind of looked at it from a portfolio approach. And I guess what I would say is we study, we move oil, we study the business of refining. If you look at it and you say, well, light, sweet crude should be more valuable, maybe you'll see a lot more of that move out of the Gulf instead of being shoved into the complex refineries. And maybe they'll bring more crude from the Middle East where, it's heavier and you're going to have it more discounted. So you could see refineries redo their slate, and that should cause more disruption, more inefficiency, and that's good for us. So I think on the crude side, it's also a positive.
Evan, you want to touch on the IMO 2020 impacts on supply, increased scrapping? I think you mentioned that, maybe fleet slowdown.
Absolutely. I mean, when the LSFO, when the price goes up, which it's just a question of how much it goes up. If it's $150, $200, $300 a ton, you're going to see more slow steaming if the ships can go slower than they are right now. And you're also going to see just an increase in the recycling, as we touched on earlier, because there's, without a question, even though I don't think you're going to see a massive culling of the fleet, you're absolutely going to have those owners who are kind of marginally thinking about whether or not they're going to pass the ship or not through a survey are going to decide to recycle the vessel. So without a question, you will see somewhat of a reduction in the fleet, and I think overall that'll help the charter rates, even with the new buildings on order.
Okay. Using our last 2 minutes here, if I, or maybe not me, but an investor gave you $100 million, what would you do with it? Buy secondhand vessels, pay down some debt, order scrubbers? And if buying secondhand vessels is your answer, give me like a sector, an asset class. Harris.
Well, I would $100 million. I would probably buy a VL resale today. If I cannot find one, then I'm going to pay back some of my prefs.
Fair. Bob Burke.
Well, we own ships, so I buy $100 million of Apple stock. So
What would Ridgebury
my
tankers do?
diversification.
We're gonna give you another option.
Second-hand MRs.
Secondhand MRs. Good call.
Okay. You know, maybe take a portion of that, and not quite half, and pay down some of our debt. And then I would take the other part and invest it in somewhere, either Aframax or Suezmax.
I would probably look for 15-year-old VLCCs, probably buy 2 or 3 of them and outfit them with a scrubber.
And operate them for a few years.
Operate them for a few years.
That's not good for your business.
But it does. Eventually, they all come to us. You know? So, we're like the Grim Reaper here. So if you operate it, if you operate the ship, you know, you write down the cost of the scrubber, you write down the cost of the V to recycling. It's a pretty good deal. So.
Randy, what would you buy?
Good question. I like the 5 to 7 year VLCCs. Put some scrubbers on it. And I have a few equities I would buy, but for those, you'll have to contact me. You can call me or email me, rgivens@jefferies.com. All right, that's it. That's all our time. Thank you so much, panel.
Thank you.
Thank you.